Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm here to help you make the most of your minerals and royalties. And Justin Williams joins me as always. Hey, Justin.
Hey, Matt. Thanks for having me.
Thanks for joining. And today we're going to give an update on the recent bankruptcies in the oil and gas sector and give you a breakdown of some of the companies that have filed bankruptcy in 2020 with the downturn of oil prices and the demand shock due to the coronavirus. And we're going to talk about what we think is potentially going to happen through the year as far as other companies that might have to file bankruptcy, give you a sense for the magnitude of this issue based on some of the information that's out there, and then also talk about a creative way that companies that are now looking to need to pay down debt, how they're going to raise money to do this, given the fact that many are having issues with trying to refinance their existing debt. We have a case study of a company that has found a really creative way to raise money without having to sell assets and properties and wells. And so this is a really interesting topic that we'll talk about. So, Justin, just before we dive in, do you have any operators that operate wells where you have an interest in that have filed bankruptcy this year?
I do. Just one, thankfully, but it's been, an interesting road to get all the paperwork in the mail, and just unfortunate that this is going to be something that I think we're going to see more of.
It is, yeah. Go look back at the past few years. There was this potentially, you could call it irrational exuberance, really low cost of money. Companies would get very leveraged, borrow money to drill new wells. There was money coming in, interest in continuing the push to drill and secure acreage. And the companies that got ahead of themselves are now facing the reality of the fact that they're having to figure a way to restructure basically because they just have too much debt. They can't make their debt payments, and so bankruptcy is sort of the only option. And so what we're going to do is go ahead and give you an update right now of the companies that have filed bankruptcy in 2020, at least through May 31st of 2020. There were 19 oil and gas companies that filed bankruptcy this year. Recently saw yesterday that Extraction Oil and Gas filed bankruptcy, which we'll do a deep dive on them here in a moment. But that would put it up to 20. I think there's probably a few others that are out there that in the past 2 weeks filed bankruptcy as well. The prediction that I've seen, reading various articles and looking at what the consensus is that there could be more than 100 companies that are forced to declare bankruptcy this year before things are said and done. And that doesn't include any of the oil field service companies that are likely to file as well, given the fact that operators have stopped drilling and completing wells. And so they don't have the business that, and they have all this capital equipment that they've purchased for the run up in activity. They're having to lay off workers. And so the reality is that, that 100 is probably a low number when you look at the totality of the industry, not just operators, but the service companies, and you include that all together, it's going to be a large number. So to put this in perspective, when we talk about hundreds of companies, in 2018, there were 18 bankruptcies. In 2019, also 18. Again, this is from data put together by the law firm Haynes and Boone, and they have a publication called the Oil Patch Bankruptcy Monitor. Definitely check it out if you want to look at some of the specifics around all of the companies. But give you a feel for how big of an increase this is compared to those two numbers. So it's really significant from that point of view. Justin, do you want to give a quick update of a few of the notable companies that have filed bankruptcy this year? You want to run through that list?
Let's do it. So the first one we have here is Southern Royalty Company, and they have around $625 million in total debt. Whiting Petroleum around 3.6 billion in total debt. Ultra Petroleum around 3.6 billion in total debt. Extraction Oil and Gas, which just announced yesterday, around 1.7 billion in long-term debt. And then the list continues on with a lot of smaller companies. And looking at the spreadsheet here, it's just the number is just massive for year-to-date 2020.
It's massive. Yeah. I think the estimate is around $13 billion in debt, total debt for the companies that have filed bankruptcy so far. You extrapolate that out, we talked again, there's close to 20 so far. If that, multiply that by 5, that's probably a pretty good estimate of where we're going to end up. Of course, if some of the larger operators file bankruptcy, which we'll talk about here in a minute, that number could go up significantly as well. So that's a give you a magnitude of the problem. And if you look at it, and again, Haynes and Boone, they gave a summary for 2015 through 2020, and the total for all of the bankruptcies during that time period was around 132 billion in total debt. So already we're at 10% of that total just for the first 5 months of 2020. So that once we're said and done, again, it could be a big percentage in 2020 that we're seeing from a bankruptcy standpoint. Now, again, to highlight the magnitude of the issue, according to Haynes and Boone, this is where we currently sit when it comes to the cumulative E&P company debt. So companies have around 70 billion in unsecured debt, just around 60 billion in secured debt, which puts it at an aggregate of around 130 billion. So again, when you talk about the magnitude of the issue, we're talking billions of dollars at play. So Justin, let's talk about extraction. So I wanted to do a little bit of a deep dive into extraction because they are the third largest oil and gas producer in Colorado, at least as of 2019. And that's behind Oxy and Noble Energy. And this is from data provided by the Colorado Oil and Gas Conservation Commission. And the interesting headline that I saw was that the Denver Post, Denver-based extraction oil and gas, latest producer to file for bankruptcy, pays millions to executives. So I'm sure that some of the folks getting laid off are maybe a little bit dismayed that the executive team is getting billions, but I want to talk about why that's the case. So Justin, what did you think when you saw this that headline?
I mean, it's definitely a little bit of a take back. And like you said, you think about all the people in the oil patch that we see on LinkedIn losing their jobs, and just really makes you wonder. But I'm interested to hear, Matt, what's your thinking on that?
Well, so the justification that they gave was that it's, quote, historic compensation structure and performance metrics are ineffective in motivating and incentivizing the company's workforce in the current environment. So what that's code for is saying that none of the executives would get any money because they wouldn't meet any of the targets, so EBITDA, whatever financial targets they have as far as that goes. And they need a way, if they're going to restructure and go through this. So there's a couple different ways that, like we've talked about before, when we went through the bankruptcy episode, you can hear more about the different types of bankruptcies. And so we're not going to go through that again, but just chapter 11, that is a restructuring. And with the restructuring, the concept would be that they may be intending to exit this thing as extraction oil and gas. So they're not going to sell off the assets to another company. They're going to try to refinance, restructure the debt, and come up with a financing plan that the U.S. bankruptcy court would approve. And in doing that, they need to retain these executives to stay on board with the company. And so it was, I guess, 16 of the top executives and senior managers. They paid $6.7 million in retention agreements. I'm sure more of that went to the C-suite folks versus the senior managers and the VPs. But just on average, when you look at $6.7 million divided by 16 people, that's around $418,000 per person. So not a ginormous amount, but not insignificant either. Again, like we talked about when people are getting laid off. So because they're going through bankruptcy court, that'll be all detailed out. There'll be line item by line item as far as what costs they're going to incur during the restructuring, how they're going to fund the ongoing operations, and that sort of a thing. Uh, the thing that this sort of highlights, so the reason we're just wanting to deep dive on extraction, and there's specific numbers we talk about here, but just want to extrapolate this to the larger ecosystem as a whole, is all of these companies have already slashed capital budgets for bringing on new production by more than likely at least 30 to 50%, and trying to reduce their G&A budgets, which is kind of code for overhead, meaning layoffs of workers, and pay cuts for officers and pay cuts for staff. And so just as an example, Extraction laid off around 20% of employees in February. As of this week, they had 150 employees and interests in 1,500 wells. And what they're looking to do by cutting their overhead, reducing spending, they're trying to strengthen the balance sheet. In other words, increase cash and pay down debt. And what they're trying to do at this stage in the game is they can't pay down the debt, so then they have to file bankruptcy. And so what they're looking to do is to go forward, how do they end up weathering the storm in the future, with decreases in oil prices, or being able to operate more efficiently with low oil prices. And so that's something that they're going to work through. And all of these companies that end up going through Chapter 11 bankruptcy are going to have to work through so that they can weather the downturn in oil prices.
I was going to say that, I think this speaks to, we've talked many times before about the companies having strong balance sheets and being able to make it through. And I think this just echoes again that, those companies really have got to focus on strengthening their balance sheet and getting back to the basics.
Yeah, no, exactly. Going back to the basics is key, reducing cost. The interesting thing to note too, so like I said, they're looking at trying to weather the storm and come out of this as a existing entity. The other thing they threw out there in the filing is the option of doing that, and then also looking at potentially a merger, in which another company would provide the money so that they could restructure and be solvent. So that is an interesting option. They're still leaving the acquisition option open if there is a suitor that comes forward that has the cash and that is interested in that acreage that they have. Now that said, there you look at Oxy as the other one, and I think they're potentially in this similar situation of having to file bankruptcy because of the debt they took on to purchase Anadarko. And Oxy is one of the largest operators in the DJ basin, and so that would be one of the bigger potential companies, but I don't think they're in any position to look at acquiring Extraction. So it would come down to potentially other operators in the basin with a stronger balance sheet, or potentially other outside companies that could come in and potentially look at purchasing Extraction. So interesting situation. I think that it's going to be something where we're going to see a lot more of this going forward. So to that end, Justin, do you want to talk a little bit about sort of what are some of the other companies out there that are highly leveraged that could face this bankruptcy issue in 2020?
Sure. This news story is very interesting to kind of look into. And one of the ones it mentions is Oxy, like you said, and maybe having some purchase remorse for buying Anadarko. Callon Petroleum, they had the 2019 merger mania. They bought Carrizo Oil and Gas and took on an additional $1.7 billion in debt. This increased their long-term debt to $3.2 billion, which, according to Forbes magazine, put them over 4 times trailing EBITDA. And I apologize if I pronounce that one. Most debt doesn't mature until 2023, which is a good thing. A bad thing is that they only have $13 million in cash, which is a little bit scary there. Chesapeake Energy, Matt, you mentioned that your prediction is that they'll file bankruptcy for the protection probably this week. And the reason is they have a debt payment due July 1st of 140 million, and it doesn't look like they will meet it. Plus, they have over 9 billion in debt, with 300 million coming due this year, which those are some huge numbers, Matt.
Those are some huge numbers. And, just again, highlight the companies that got highly leveraged. So we're talking about Oxy and Callan Petroleum. They took on a significant amount of debt to acquire competitors. So, again, like you mentioned, Oxy purchased Anadarko after a bidding war, and they ended up, paying a significant amount of money. They had to borrow from Warren Buffett to fund that acquisition. They're having to pay Berkshire Hathaway and Warren Buffett a significant amount of money, just for the interest to that investment. And so that has hampered them. And then they had to pay $1 billion to Chevron because Anadarko breaking the agreement they have with Chevron for Chevron to acquire them at a lower cost. And so forking over $1 billion in cash, taking on, additional debt to pay $55 billion for Anadarko. So they had 35 billion in debt. And like I mentioned, they're just having a heck of a time trying to service that debt with prices of oil dropping down into the $30 range. And so, the way that they maybe survive this is if they get super lucky and the price of oil rebounds to over $50 per barrel, then maybe they're profitable enough to start generating cash again, paying down some of that debt. That's unlikely. The thing that is more likely is they're going to have to sell off assets to try to pay debt. And again, whether or not they're going to get enough, because again, we're talking having to sell at the bottom of the market with price of oil at $30 a barrel versus looking at selling it at the top. And so they're going to end up in a tough situation. And so I think they're potentially at risk. Again, who knows? It would probably be one of the biggest bankruptcy filings across any industry if they end up having to file bankruptcy, but I do think it's a possibility. Again, highlight Chesapeake Energy. So $9 billion in debt is an enormous amount of money. And even just a relatively quote unquote small debt payment of $140 million due July 1st, that they probably aren't going to have the cash on hand to pay that. Or if they do pay it July 1st, then the other 160 million that's due later in the year could put them over the edge. So my prediction is they're going to file this week, like Justin mentioned. We were talking about this beforehand, and that's kind of my if I'm reading the tea leaves, I'm thinking that that's going to happen. Again, there's some other rumors that folks that on the street saying that that's going to be the case as well. And so that's going to be another big one. And the other side of this thing that I want to talk about, so we mentioned, having to sell assets to raise money to pay the debt. Unless you already had planned to sell those assets because they were not strategic or, didn't fit in the, your overall portfolio going forward, it ends up being a fire sale and you don't get the full long-term value of that asset having to sell at the bottom of the market, like I mentioned. So a creative way that some companies may look to raise money without having to file bankruptcy so that they can service their debt is one example that was just announced yesterday, actually, the same time that Extraction is filing bankruptcy. Antero Resources, also an operator based in Denver, announced the closing of an overriding royalty interest transaction with Sixth Street Partners. And what they did is they sold an interest in existing production and also future production over the next 3 years for $402 million, of which the proceeds will be used to pay down their revolver. And the effective date was April 1st of 2020. And so what they're doing is basically they're paying down their debt with the proceeds of this transaction so that they can avoid having to file bankruptcy. So, Justin, what was your take in hearing about the Antero announcement?
I think it's great. I think it's a creative idea for them to bring in some cash, but at the same time still be able to retain their core acreage. Because when companies sell off their core acreage, what are they going to do then?
That's exactly right. Yeah, if they're selling off their core acreage, the best acreage, and then they're left with not much, and it's sort of like the pointless exercise, in my opinion. So I think this was a really creative way of raising money without having to do that, like you mentioned, and they're getting a pretty good chunk of change and only having to give up a 1.25% overriding royalty in existing producing wells and a 3.75% overriding royalty interest in existing acreage for any wells completed over the next 3 years. And they get most of the money up front, and the rest will be received over the next year, contingent upon them meeting production targets. So, the company that is buying this is looking at this as a source of cash flow in order to repay that investment back, and so they need Antero to continue to produce at some minimum level in order for those financial targets to be met. So that's sort of a safety net they put in there, which I thought was pretty cool. uh, Again, the interesting deal of this is they are purchasing a big chunk of their unsecured debt. So they repurchased an additional $196 million of unsecured senior notes during the second quarter, and doing so at a discount, mind you. So those bonds were trading at a discount to the stock price, and so they're able to get a little bit of a discount on that. And then what they say also is they have 540 million notionally of 2021 senior notes that remain outstanding. So those are notes that are due in 2021. So it staves off the immediate concern, but again, they look at needing to have significant liquidity into 2021 so that they can continue to pay down that debt and repurchase those notes. And so that's important. And they're like they said in the press release, Paul Rady, who's the chairman and chief executive officer of Antero, said the overriding royalty interest transaction addresses over half of our 650 to $900 million asset sale goal for 2020 and allows us to pay down debt while importantly retaining the long-term upside of our core acreage position. And so that was key, like you mentioned, Justin. So a bright spot there, I think, in terms of a creative way that companies might use existing assets and core acreage as a way to sell a portion of that and raise money without having to sell the farm. And so I think that was very cool to see. And the thing too that's on the plus side. So this was Sixth Street Partners, and the thing that we mentioned before is that a lot of these oil and gas companies are having a hard time refinancing debt because there's not an appetite to do so because again there are questions around the solvency. And by selling an override, you're selling, like we've talked about before, an interest in those leases. And so that's an actual thing where they're going to get an assignment document. It'll be recorded and they can go forth and that's plus there's additional terms outlined in that in this case Antero has to live by, but they're getting paid back through the production payments. Really creative way too that when you think about doing so at $30 $40 oil with the anticipation that you would see hopefully $50 oil in the near future. And so they're trying to lock in that before the prices go up. So it's a good upside potential for any investment companies that look to follow suit. So any last thoughts, Justin, before we wrap up?
No, I mean, I think we covered it well. It's sad to hear all of the bankruptcy happening, but like you said, the last story is refreshing to see that companies are kind of looking at alternative options, and hopefully we'll see more of this in coming weeks as the companies have to review their options.
Yeah, I hope that you're right. I hope we see some more creative situations like the Antero option. Again, if you want to learn more about what to do if your operator has filed bankruptcy, we covered that in episode 58 of the Mineral Rights Podcast. So check that out. We'll have links in the show notes to that episode. Again, thank you for listening, and please subscribe to the show wherever you get your podcasts and leave us a rating and review, and we appreciate it.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.